Well, let's take care of some questions. I think I'm a day late on getting this up. It's not clear to me what long ZQ futures means given the contracts are inverse the resultant FFR rates. Are you long the FFR rate going higher or long the FFR going lower? When you're long, it means that you benefit when the underlying moves up. Since the underlying is an index, which is 100 minus R, for the index to move up, R must move down. So I'm in essence short the federal funds rate for that particular month. I'm long the index. A bit afterwards where you describe long ZQ as negative dollar delta beta does not offer me clarity, as at this point in the cycle a decrease in FFR could be positive or negative beta. Okay, my forecast is for a recession. And you have to position yourself for your forecast. You can't wait until something happens and then take a position because everything's already priced in at that point. You have to anticipate, and when you anticipate, if you're right and a recession occurs, you are rewarded. If you're not, well, that's the risk versus reward. If you're going to make money in the market, you're going to accept some types of risk, the risks being that your forecasts are wrong. If there is a recession, equities and treasuries have a negative correlation with the economy. Equities and bonds have a positive correlation with rising rates due to inflation. So if, as we've seen during the last year, bonds are not a hedge against inflation, and rapidly rising rates were negative for equities. And as long as there's no QE, which is quantitative easing, you should get that negative correlation in a recession between bonds and equities. So in a recession, you can short the market or you can go long bonds. Both of them would act as a hedge. Let's see, depending on the reason, soft landing scenario would be ZQ contracts up because the Fed funds rate is dropping, which means ZB would increase as well. FFR down, market up. So market up, ZB up, great. Where something broke, time to E scenario would be ZQ contracts up, FFR down, which means ZB up, market down, beta down. There's your negative correlation, right? Yeah, negative correlation between the two. So you have the logic there. What are your thoughts about buying stocks below a major moving average like the 200-day moving average? Is there more risk of underperforming? I don't know if there's any empirical evidence that shows buying below the 200-day moving average produces worse returns than buying above it. Well, that is called a back test, is that you would have some kind of theory that stocks that are a certain distance below their 200-day moving average represent buying opportunities, and then you would back test that. But just to be very clear, the S&P 500 for most of 2022 was trading below its 200-day moving average, and buying it was not on average, if you bought and hold, was not a winning strategy. You had to wait until it was a certain distance or a certain number of standard deviations of return below its moving average. Well, how many standard deviations would that have to be? You'd have to go back and back test something like that over a period of time. You'd have to back test at an index level and at a stock level because those two things may be very, very different. Tesla's under its 200-day moving average. It's been there for quite some time. That has not been a winning proposition. Beyond Meat's below its 200-day moving average. That has not been a winning proposition. ARC is below its 200-day moving average. That has not been a winning proposition. So something, just one indicator like, oh, it's below its 200-day moving average, I'm going to buy it, doesn't seem to make a lot of sense if you're looking for a contrarian indicator. I don't think that that would be what I would be looking for. If you combine two moving averages of 50 and a 200, and if the stock is below the 200, let's say the stock is down here, this is the 200, and you see the 50-day moving up above the 200-day, that is typically a buy signal for a stock that's under a 200-day moving average. But again, that is purely just technicals. That's ignoring all news, all economy, all fundamentals. And the technicals have some power when there is no news. But when the fundamentals show up, technicals are, like the red-headed stepson. They get thrown out very quickly. Okay, is there a way to benchmark a portfolio on IB? Why would you want to? I guess would be my question. Why can't you just look at the index? So let's say that you're benchmarking against the SPX. At the end of the week, just look at what SPX is year to date. At the end of every week, just pull up a chart of year to date and calculate, or actually just look at a performance chart. If you have CoiFin, just call up SPX, click performance chart, and click on year to date. And at the far chart, it'll tell you, plus 2.13%, minus 4.6%. And then just look at your portfolio and what was your January 1st balance, and then what is your year-to-date balance, and calculate what your return is, and just do it that way, if SPX is your benchmark. Could you please explain the difference between real yields versus break-even yields? So you have a nominal yield, let's say it's 4%, and you have a real yield, let's say it's 2%. That means the inflation break-even is 2% because a nominal yield equals a real yield plus some inflation expectation. We write inflation expectations as pi to the e. It just isn't shortcut as opposed to writing out the word inflation expectation all the time. So let's say that this was a 5-year nominal yield. If you expect over the next 5 years for inflation to be higher than 2% on average, you would buy a real yield bond. If you expect it to be lower, you would buy a nominal yield bond. So in essence, 2% is called the break-even point, where you're indifferent between a nominal and a real bond. Have you tried backtesting any of your trades or investments, and would you favor a particular piece of software? You can't backtest expectations. I expect a recession this year. How would I backtest that? Right? I expect housing stocks to outperform this year. How would I backtest that? I go back to last year. Oh, they outperformed. The year before, oh no, they didn't. The year before, oh no, they didn't. The year before that, oh yes, they did. I mean, it would be meaningless to backtest an expectation. You would only backtest a mechanical trading system. So if you said, I'm going to write a mechanical trading system that sells 30 delta puts. I'll sell 30 delta puts for all equities that are one standard deviation greater than the 50-day moving average. And I think that I've got something there. Well, I would backtest that because it's a mechanical trading system. But if I say, I think stock XYZ will outperform this year, well, that is because I have a certain expectation for what the year will be. You can't backtest an expectation because, well, it's history was what it was. That's it. Just because the stock outperformed last year doesn't mean anything for your expectation this year. It's not like you would say, oh, it didn't outperform last year, so it failed my test. I'm not going to do it. Only a mechanical trading system or a quantitative based system where it's rules based and you just put the rules in place and you walk away. And then the algorithm executes all of the rules for you, buys and sells, and you've back tested it and it's made money in different regimes, then you could use it going forward. What is the difference between selling a June ES contract at $39.50, selling an SPY call at $3.95? Well, I have I shouldn't say unlimited loss, unlimited gain here. I have my gain and my loss are not limited. That's especially for the gain. Whereas if you sell a call at $3.95, your loss is not limited, but your gain is limited. So on both these, my loss is not limited. On this one, my gain is not limited, but my gain is limited. So the $39.50, the ES contract wins in that sense. The most I can make here is what I sell the call for. If you think about it in terms of a payoff chart, here's $39.50. And if I have the futures, if I'm short the futures, as the market goes down, I'm making money. So I have a linear payoff in that sense. Whereas if I sell a call at $3.95, the most I can make is whatever I sell the call for. And then after that, I have limited loss in that sense. So there's the difference right in that top corner there. What are the factors that may lead to an outperformance of IG versus high yield and short versus long duration while a recession? IG would outperform HY, but that doesn't mean IG will go up. It just means it will outperform HY. High yield bonds may drop 20%, but high yield bonds may drop 8%. Well, that's still outperformance because you use that word, right? And what would outperform short versus long duration? Well, if you're a short duration, you think rates are going up. If you're long duration, you think rates are going down. That's it. What's the best vehicle for equity exposure? Depends on what equity exposure you want. Large cap, SPY. What you want is an ETF on which there are options that are very liquid. There may be other ETFs with lower management fees. I'm never concerned about the management fees, really, because I use the market more as a hedge against a portfolio. In good times, I don't bother with the index at all. I mean, I may sell puts on the index, but I bother with individual names. So, SPY, IWM, IJR, depending on what index you want, just make sure you have very liquid options on it so you can do risk management quickly. Given the possible volatility in the next week of CPI and earnings, do you believe the long straddle on SPY might be an appropriate strategy for these approaching data points? I don't know. The last big event we had in December, on the 13th, you had CPI. On the next day, you had the Fed decision. And you had the Tuesday close. The Monday close. This was Tuesday morning. This was Wednesday. And then you had the Wednesday close. The difference between these two on the index, I think, was about 10 points. Barely moved. But it did all of this in between. But over that period of time, it barely moved. So selling a straddle made a lot of sense, but I never would have taken that bet on doing that. So you have to have some idea that, no, I don't think the index is really going to move much. And if you believe that, then that's what you would do. I don't play individual risk events for just a profit on the risk event. I use risk events to think about how I want to potentially protect everything else that I have, or if I even want to or I care to. But I don't make a binary independent bet on a risk event because you're either right or you're wrong, and there's no salvaging it. Always hear people talk about repo. Who really has access to reverse repos? The banks, typically banks. Some money market funds do as well. Some, but it's typically banks. What kind of financial institution are you using? The park cash or short-term securities? Short-term T-bill yields are low because too much demand pushed up their price. Isn't that becomes an arbitrage for institutions who have access to the repo market, borrow ultra short T-bills and enter repo to get the Fed funds rate? From a theoretical perspective, sure. From a practical perspective, I doubt that they would be able to borrow those. It would be a matter of if somebody had to buy them because they had to buy them. And I don't know that they're in the position to be lending them. The borrowing and lending for this kind of thing, no, I without getting into too much detail how that market works, I don't think so. You either need some securities on your balance sheet because you don't want cash, or you can't buy certain securities in the market, and you can always get better return with cash. The rates are there, and the Fed does this to keep a target range. So if their rate is 4.5 to 4.25, they use those rates, repos and reverse repos, to target the range within there, to try to keep the interest rate within that range. Let's say that you own an equity that's currently trading at 100. Let's also say that you want to sell a small covered Strangle at 95, 105 because you want to add up if price drops and you want to partially scale out on a rally. In this scenario, would you rather sell the 95, 105 Strangle now when the price is 100, wait for the price to rise to 105 and sell the at-the-money call, or drop to 95, sell the at-the-money put Just wondering whether it's worth waiting for price to make a move. No, I would do the whole thing. And if I am doing this kind of thing, I'm usually using a 30 to 45 day 30 to 45 day option to get that done. Really short term, because you're selling short term periods. Remember, you're getting a premium here and you're getting a premium here. Well, the stock cannot both be above 105 and below 95 at any given time. It can't be in both places. So when you do this, you're actually doubling your premium. So you're getting called at 105, but you got two premiums. You're getting put at 95, but you got two premiums. You're going to win on one of the legs or both of the legs. If the stock stays between 95 and 105, you win on both legs. If you get called away, it's not just the premium on the call that you got paid for, you got the premium on the put. And if it's put to you, it's even lower. So if you got $3 on each side, that's a total of $6. So it's not the same as waiting for the stock to rise to 105. You might not get $6 because of the passage of time and selling the call. So no, I would do both at the same time. Can I use the forward 10-year minus 1 year to determine market expectations of future growth? That's way too far out. So if you think about a timeline, and here we are today, there's 10 years, there's 20 years. What you're doing is you're looking at this period of time. That is way beyond one business cycle. You want to look ahead one business cycle. So this is 5 years out. Here's the next 5-year period. It is fairly safe to say that within this 5-year period, there is not a lot of influence of current monetary policy. So whatever those forward rates are, they must be reflecting growth and inflation. Going out here is just way too far. In your market update 1 or 2 weeks ago, you mentioned that a barbell portfolio might be okay for positioning under current situations. I don't think so. I think what you might be thinking about is somebody asked me to describe a butterfly trade because there is a butterfly ticker that you can take, which has two long positions and a short position, and that is to if you're expecting, let's say you have a curve that looks like this and you're expecting the curve to do something like this, add curvature. There's where you would be long the barbell, short the bullet. But for a curve steepening trade, if you're not sitting in a bullet, you are basically long the short and short the long end for steepener, and you're duration neutral on this one. So TUT is a good example of something that is very, very close to duration neutral, where it is short 2 times the 2 year and it is long 2 times the 2 year and short 1 10-year, so that you really just benefit from a curve that is steepening. Let's see, what parts of the yield curve. Now, when you're thinking about when you're saying the bullet portfolio is better for yield curve steepening, this is if you are restricted to long only. So you have a portfolio of bonds and you can only be long, and you think a curve is going to steepen, and you have bonds all across the yield curve from the 2 to the 20, and you think the curve is going to steepen. You want to move your long positions closer to the belly of the curve, because if you can't use derivatives or you can't use short positions, the only thing you can do in a long only portfolio is position someplace on the yield curve that has the least amount of damage. Let's see, what other parts of the yield curve are you expecting to steepen in or remain unchanged relative to the others in your barbell positioning? Well, I don't know. You really can't do much for the 3-month versus any other position, only because the 3-month has absolutely no duration. So trying to get duration neutral on that would be obscenely ridiculous. So you have the 10 to the 30. But the 2 to the 10 will be the more volatile, will be the more interesting curve steepener, because you have QT going on, or quantitative tightening, although it's not really quantitative tightening, it's balance sheet runoff. Everyone just calls it QT. If you have QE going on, the 2 to the 10s have very low volatility. You'd want to play the 10 to the 30 slope because it'll have more volatility. but we don't have that. So the 2 to the 10 is sufficient right now. If you do have QE going on, another interesting curve is the 5 to the 10. Because the short end of the curve all the way to the 5 will be held down because of the purchasing, even though some of the purchasing will be on the 10-year. The rates all the way to the 5-year would be held down by the very short rate because you wouldn't have a very steep curve to the 2. Usually the 5 to the 10 can be quite steep, but right now the 2 to the 10, because we have an inversion, any steepening, the 2 to the 10 has probably the best I think play. I don't know, maybe there's a fixed income portfolio manager out there who's done curve steepeners before that might have a different opinion, and it also may differ depending on what yield curve you're looking at, or I should say which market's yield curve you're looking at, the Canadian, the US, the European. Maybe there are different parts of the curve that respond differently based on clientele effects. I don't know. Can you please explain what does long ZB June contract mean in terms of exposure? You said ES means owning 5 SB contracts. Does it have a similar payout? Kind of, yeah. So every treasury bond futures has a generic bond underlying it. This generic bond doesn't exist, okay? But it is a generic $100,000 6% bond. The short side can choose what bonds to deliver, but what they deliver must be comparable to a $100,000 6% bond. So there'll be some underlying, some cheapest to deliver. And there'll be some conversion factor. And it's the conversion factor applied to the cheapest to deliver that determines how much of that particular bond you must deliver such that the return on a $100,000 6% bond would be equivalent to the return you would get on this bond multiplied by its conversion factor. And right now ZB futures are sitting at about 126, so that's 126,000. So if it goes from 126 to 125 and you're long, you lose $1,000. That's all. That's basically how it works. Is it's the price of the total amount of bonds that would be delivered. So because there's nothing with a 6% coupon, you'd have to deliver more than $100,000 worth of bonds just to offer the same yield as a par 6% would. Well, I shouldn't say a par 6% would. A 6% coupon would. You mentioned that you never start an initial position at its full potential size to begin with. Haven't you found that so many moves happen in the time that you are in the building phase of the trade? Yes, I do. And I've said that many times, is that, you know, I like to build into a position, but markets move so fast now, you almost have to take your full position right away if you want something. But in the past, whenever I've gotten into trouble, it's usually because I took a full position right away. And it moved against me initially, and it becomes very painful because now I have nothing to do but wait. So if I take partial positions, it allows me to see what the market thinks so that I can then adjust from there. So greed doesn't get the better part of me on day one. You mentioned that this happened recently with the home builders. Yeah, the home builders run and they're still running. However, nothing ever does this. There'll be one of these at some point, and if you have patience, you will win. And as Warren Buffett said, and I agree with a lot of the neat little things he says, but I think he's so right on this one. He's saying the market is a wealth transfer mechanism from the impatient to the patient. And one of the disciplines that you need in this market is patience. Seems like these days markets have become so efficient where you have to really go in once you've identified something, or at least go in enough so that you stand the benefit if things take off straight off the bat, or have enough ideas, what your trading plan is. So it's not a matter that I say I'm going to take a 25% position in ABC. Before I take a position in ABC, I already know when I'm going to, not so much when, but under what conditions I'd move to 50, I'd move to 75, I'd move to 100, or I'd say, okay, 25 was a mistake, let me get out of that. And it's a small enough position that if I got to take a loss on that, I will. Although if there are actively traded options on it, I can usually within a month or two work my way out of any situation. And then I just determine the conditions under which I would take more positions, so that if something happens over here, I can ask, is this the condition under which I would say no? And if the answer is no, then I would move to 50. So if I buy ABC and it pulls back and my thesis is still in play, that's when I move to 50 and I'm sitting over here now. And I could move there in a number of ways. So the way I like to do it is, let's say this is the stock and I buy ABC right here, and let's say it's $50 and ABC drops to $44 over the next 6 weeks. Well, if my thesis is still correct and I like this idea, I would probably go out 30 to 45 days and sell a 50 put. Because rather than buying more at this point, I will get a little bit of premium on this. Why would I not just sell a put at the same price of 44? Because if I sell a put at 44 and it goes up, all I make is the 44. I want to engineer it such that it will be put to me and I will get a lower price than what the market has right now. And if it really does go up and crosses the 50 line, well, I've made some really good premium on that. So, I may do something like that. I may sell something maybe at 47.50, or I may say, well, let me sell the 45s, but let me sell two amounts of the 45 that if they are put to me, I'll end up with a 75% position instead of 50. A lot of it is, it's not hard and fast rules. It's, when you get to a particular point, you assess. And you have multiple strategies that you could use. You decide, well, do I absolutely want this to be put to me? Do I maybe want this put to me? And I think that if I sold puts at this price, the price it would be put to me is the price I'm looking for. Maybe. It depends. Do you have any concerns that the TLT trade might end up only working in 2024 instead of 2023? It's possible. Again, I have an expectation for what I think the future is going to look like. And I position myself today for those expectations. And if those expectations happen, that is the reward part of this business. If those expectations don't happen, that is the risk part of this business. This is the business we're in. You must be aware of the risks. The risks are you're wrong. That's the only real risk out there, is that you're wrong. And then, what do you do after that? Well, I'm already working my way to a cash neutral position by selling puts on TLT. So I bought some calls, I'll sell some puts. And I'll just keep going from there until I change my mind. That's the trade that I'm looking for. If I think that I am wrong and that I may lose money on the calls, I don't mind the underlying being put to me sometime later in the year to get cash neutral, because then I would be long the very thing that would go up if the recession is in 2024. So I don't know when long duration's really going to start to pay off. I just know as of right now that the long duration is a better trade, I think, right now. If I had to pick long beta or long duration, I'd be long duration. When looking at inversion in the Treasury yield spread, does it matter if you look at it on nominal basis or real terms? Well, nominal is real plus expected inflation, right? So if you look at the curve in real terms, that'll give you some expectation of what the market is pricing in for GDP growth. So looking at nominal gives you the two combined. And real yields will reflect real GDP growth, and there are your inflation expectations. So if you're looking at it in nominal terms and you're saying, well, where's the effect coming from? You can look at it in real terms and isolate the two different effects. I have two questions. What do you think about Starwood and REITs in general at this time? I like them. I've always liked REITs because REITs are such a powerful tool for wealth building. Everyone sort of thinks they're boring and stodgy and, they belong in your grandfather's portfolio, but they don't. They have huge cash flows on them in terms of the dividend yield that they get. Now, the dividend that you get is no different than interest because they're not qualified dividends. So you got to pay. They're just the same as having normal income. but they pay monthly, so your reinvestment rate is really fast, and you do have capital gains that come with them as well. And you give me a good REIT with nice options in there, I can double, even triple that dividend over the course of the year. So you give me a REIT that has a 6% dividend. Now this is taxable as ordinary income, but I can double that dividend. I can get another 12%. Well, 2 times 6. I can get another 12% if it has good options. Those are all cap gains. Plus the underlying price tends to move up over time. Well, it is business cycle sensitive, but it tends to move up over time. One thing that is important to understand is for REITs, the dividends as a group, the dividends tend to be far more stable than the business cycle. In other words, the volatility in the dividend is significantly lower than actual or real volatility. And the volatility in the price of the underlying asset is far less volatile than the fair market valuations that go on all the time. So because of that, because the real volatility in the business model is significantly lower than publicly traded volatility is, it always is a good buy. There is this belief that private real estate understates volatility. I disagree with that. I think that publicly traded real estate massively overstates volatility. And because of that, because it overstates volatility, they give you these beautiful buying opportunities all the time. So every time REITs pull back 30, 40%, I think it's ridiculous that they would fall back 30, 40% when rents are increasing. This is just the stupidest thing I've seen, but I'll take it. Thank you very much. It would be like quitting your job every time interest rates went up because the present value of your future income goes down. And who would do that, right? Anyways, I've always been a big fan of REITs. Again, because of that cash flow that comes into your portfolio every month, that steady cash flow that gives you opportunities to buy more of something every single month. It's that compounding that is extremely powerful. In the first 3-4 years, you're not going to really notice that compounding effect. It'll be small, but then it really starts to grow when you're adding 5% to a growing balance every year, 5-6%. Other than owning TLT and perhaps 1-year treasury. Okay. Earlier, I had a question about a barbell strategy, and I said, I think it was in relation to something else. This is probably what you were talking about, where I said buy the 1-year treasury because it was yielding like 4.7%, and TLT, which is the 20-year plus, that seemed to be a fairly good strategy. Do you also, now, this is not a curve steepener trade at all. This is a levels trade. Okay, so the yield curve breaks down into 3 factors. There's levels, which is captured by duration. There is slope, and there is curve, right? If you are a long-only portfolio and you think the curve is going to steepen, that's where you would want a bullet portfolio. But if you're playing levels, you want to add as much duration as you possibly can. Well, you want to be way out at the end of the curve because you think levels are going down. Do you also think owning individual investment-grade corporate bonds with a duration of 3 years or slightly more makes sense at this time? 3 years or slightly less. 3 years or slightly less. In investment grade, there's I forget where I saw it. It was in one of the CFA primer readings for fixed income that there's some research presented showing the different buckets, the 1 year to the 3 year, the 3 to the 6, and then, or was it 1 year to the 3, the 4 to the 7, 7 plus, that the best returns were in the 1 to the 3 year. So 3 years or slightly less. Makes sense at this time. Yeah, if you can get them. If you can, I don't think you can get corporate bonds through IB. I think they identify, you can find corporate bonds, but I don't know that you can trade them through IB. You'd actually have to call the dealer desk. Not a bond investor, not sure how to pick up the right amount of duration to lower the overall risk and at the same time take advantage of potential lower rates in the near future. Well, if you're gonna play, when you're talking about bonds, you have to be clear: are you playing the interest rate or are you playing the credit spread? Or are you playing both? If you buy a corporate bond, you have all the interest rate exposure that a treasury does, and you have a credit spread. So if you're only playing interest rates, why take on credit risk? Why not just play the treasuries? If you hit a recession and interest rates drop, credit spreads tend to widen. So with an investment grade bond, you might not get a payoff to the same extent that you would with a treasury, because what would happen is rates would drop, so prices would go up, but your credit spread would widen, so prices would go down. The credit spread would offset some of the interest rate that you got. So if you're going to play fixed income, you have to decide, well, what are you playing? Are you playing the credit factor, which is the spread, or are you playing the interest rate factor? And if you're just playing interest rates, do it with treasuries, because now you have no credit risk that could offset the gain from the move in rates. Let's see, makes sense. Not right amount of duration. Pick up the right amount to lower overall risk. At the same take advantage of low rates in the near future. Perhaps looking to see if you also pull the yield curve and how you identify the optimum place for duration. If you think rates are going down, you just add duration, and you add as much duration as you want. I don't know that there's an optimum place. Duration is the sensitivity of the bond to changes in rates. The long end of the curve doesn't change as much as the short end of the curve. It'll change more in rates, but it has such a low duration. Whereas the 20-year, the 30-year have bigger duration. So not really a bond trader per se. So, the bond trader out there may say, no, over history it's shown that if you buy somewhere between an 8 and a 12-year bond, it's the best. I don't know. Maybe that's the case, but I would just simply add duration. You can get that with Treasury futures. Although they're not that liquid once you start going out more than 2 quarters. Like if you're trying to get a Treasury future out for 1 year, I don't even think they're even listed out for 1 year. I think you have as much as two quarters ahead, and I think that's about it. But they lose liquidity rather quickly, so maybe it might not be the best thing. Well, you can always continually roll over, and you'll just have a bunch of realized losses until you have a gain. But every time you roll over, it doesn't change your original price, but you do have the carry of doing that. So maybe buying the actual bond would be better. Would you please cover some of the option strategies used to fix a losing position, whether it's owning an equity or synthetic equivalent? I have done that in the applied series with ChargePoint. I intentionally sold puts on ChargePoint knowing I would get into trouble. I sold $18 and $17 puts so that 2,000 shares were put to me, and I showed how to get out of a situation like that. And then ChargePoint fell all the way to $12 as I was holding this. And it's just a matter of rolling down your calls. So in the for the extras, the weekly update I'm going to do on Sunday, the extras video, which only goes to the applied series, I'll show you what I'm doing with Tesla, because I said that I had bought Tesla and immediately sold the straddle on Tesla, which gave me a really wide break even. Well, that was at 126. I sold the 126.67 straddle. Since then, I've rolled down the 126 to the 100, and on a rally, I rolled the 125, the 126.60s down to a 120 put, and since those rolled down, down to 90, so that I have I'm moving down with the stock price. So by the time the stock price finds a home, my options will have found a home with them as well, and I will have gained most of the downside of the movement, but I'll explain that in the extras series for the applied series holders. Okay, it was interesting hearing about your overall experience trading and managing your portfolio in the last Q&A. Could you describe and reflect on your performance over the years? That's a long one. I'm curious what the biggest takeaways are for someone with your expertise and experience. So that one I can answer. The biggest takeaways is you should have a plan before you start trading. When people first are drawn to the markets, for whatever reason, a lot of retail investors I wouldn't even use the word investors. They're more traders. I wouldn't even use the word traders. They're more gamblers, I would say. Treat the market as a big casino in that they buy and sell, buy and sell. They have massive turnover in their portfolio. They generate short-term capital gains, which really don't have any tax benefit at all. So on an after-tax basis, they do very, very poorly. Not only that, about 90 to 95% of them are usually out of business in the first 3 to 6 months. If there was an index where you would take something like Robinhood and you would say, I want all the individuals with extremely high turnover in their portfolio, in other words, very short-term trading that tend to use margin, and give me the total sum value of that and create an index of that, I would short that index all day long. I would short it, because if you trade that way, you're going to run out of money. If you live at the edge of your margin all the time with these binary bets, all in, all out, one of them is going to take you down. You will blow up time and time again. Have a plan. What is your goal? What is it that you want to get done? And saying, well, I want to make money. That's not enough. Be very clear. Do you want to generate capital gains? If you want to generate capital gains, do you want to generate tax efficient capital gains? Or do you just want to do what you see on TV, sitting in front of a bank of 6 screens and buying, selling with a Lamborghini out front? Because that's just in the movies. That's not real. And all that stuff you see on YouTube with all these 20-some-year-old traders saying, this is my car, this is my house, you could be like me. That's not real, okay? Those are all just props that are rented for the sake of the video. Have a plan. How do you want to make money? Do you want to make a regular income? Do you want to live off of investing? In other words, you want this to be your career, you want this to be your job. Do you have a career and job and this is just really to grow your retirement savings or to earn extra money on top of your money? Have a plan of what it is and know what it is. The other rule I would stick with is trade what you know. So if you hear about a particular stock and you know nothing about it, don't trade it. Learn about it first. What's going on with this thing? Is it just a story or is there something here? Trade what you know. Now, when you have a plan and you trade what you know, you'll know when you're in trouble because you'll know what it is you're trading. You'll know when you're in trouble, which means be aware of all the tools that you have for risk management. Too many people enter this game with nothing but reward in mind. Reward, and they treat it like a casino. I want you to enter this game with a plan. I want you to stick with what you know, and I want you to be aware of where all the risks are and what tools you have for risk management. You can't manage your return. If you buy a stock ABC, the return on stock ABC will be what the market wants it to be. There's nothing that you can do about the return for stock ABC. But you can do a hell of a lot to manage the risk profile of ABC to only take on that part of the distribution of return that you want. So you can trade different parts of the distribution as opposed to one. Those are probably the biggest takeaways. The times in the past where I've ran into trouble is trading something I don't fully understand. Because when it moves against you, you don't know why it's moving against you, so you don't know what to do. Should I buy more? Should I get out? What should I do? Whereas if you really understood what you were trading, you might not have entered that trade in the first place, and you might not have been knocked out of the trade once you started losing because you understood that, well, hang on, it's dropping not because of any risk reasons, it's a risk-off day, a risk-off couple of days in the market. It's going down with the market and not anything particular. And, over time, you will get experience, and experience will lead to this thing that's hard to quantify and hard to teach called intuition, where you can just look at something and look at a reaction to something and your gut just tells you just something's not right here. This doesn't feel right, and you know when to move. And finally, the biggest one, patience. And if you are emotional, get rid of that shit right away. Get rid of that right away. You have to be unemotional about your money. If you are emotional, then you're going to need rules such that your emotions don't get the better part of you, like a limit to the maximum position size that you will take. And maybe it's no more than 2% of assets. Until you master that emotion, then you can move to 3% of assets in any one position. Until you are not emotional about that anymore, then you can move to 4. But if you are emotional about your money and you see the value drop, you have these big positions and you're losing money and you're getting angry, and that's not going to be a good outcome for anybody. You have to be unemotional about your money. And if you balance your portfolio such that you have positions in there, especially in volatile markets, you need positions in there that if one goes one way, the other will go the other way for you. Or at least you're using derivatives and options to try to get yourself as neutral as possible. And that all comes with experience as well and education. These are the big ones here: emotion and patience that will take you down if you don't have that in the beginning. And you will go a long way managing your emotion by having a plan and having rules that you follow, and trading what you know so that you have very limited opportunity to become emotional. And it's like any other career. The longer you do it, the more experience you get, the more intuition you build, the better you become. So that would be my sort of broad advice on that. I am new to option trading. I'll be struggling in determining my strike price and expiration date. What was the first thing you look at when you're choosing your strike and expiration date? I don't know that I have a first thing that I look at. It really depends on what it is I'm trying to get done. There is no one rule. It's, first of all, what do I want to get done? Do I want to sell the position I have? If I do, then I'm selling in the money calls. Do I want to make some extra money on the position I have and not get them called away from me? Well, then I'm using 30 or 20 delta options. So first it's, well, what do I want to get done before I decide what it is I want to do? Am I buying? Am I selling? Where's the level of volatility? How many months out do I have to go? What's the liquidity on these? So there's a lot. There's just no one answer for that. Are the options physical settled? They can be. If you don't close them, they will be physically settled. Index options are cash settled. Under IBKR, how do I look for the option contract details to see the settlement type? Well, all options are for 100 shares, and there is no choice. It's 100 shares of the underlying. On the applied series, there is the options course inside the applied series on my site. The applied series is $320 USD. Every so often I keep adding to this. The next video going up probably later today or tomorrow is factor investing, with equity factors and duration factors, and how you would position those over the business cycle, and some unsatisfying truths about factor ETFs. They're not really factor ETFs, but that'll be in the video. If you only want the options course, it is available as a standalone option for $220. It is a complete course. This one is done. It's going to get an upgrade this fall. So this fall I'm going to upgrade it again. So if you have it for $220, you have the current version, and then there'll be an upgraded version, which just because of all the questions that were asked, highlights to me that, well, I could go into a little bit more detail here and a little bit more detail there. Plus there'll be the beginner part of it, which if you already know something about options, you don't have to do the beginner videos. They're based on a textbook from John Hall. I can expand that and do that a lot better. So this fall, that part is going to get an upgrade. Are treasuries with maturities of less than 1 year considered collateral against sold puts and IBKR? Yes, they are. Yes, they are. I'm currently selling cash secured puts on securities I don't mind owning, but still have a big cash position that's sitting in my account. Nice thing is IBKR does pay cash, does pay an interest rate factor on your cash. If you have U.S. cash, I believe it is paying 3.8%, which is, if you're buying 30-day treasuries, I think you're getting 4.1, 4.15 now. So your idle cash is making money. You are making money on your idle cash. I would like that cash to yield more while I'm selling puts and slowly building up my positions, but I'm not sure if that has any implications. margin call or high borrowing costs. No, if you have a cash equivalent is a money market security with a high level of liquidity and almost no duration risk, which is your 3 to 6 month treasury series. If you have that does count as collateral against any margin that you have to come up with. So margin, as I've said in the past, margin equals me. It's what you have to come up with. That is the amount of cash that you have to have available to secure whatever it is you're doing. This is a cash equivalent, which is cash or cash equivalent can be used for it. If you have portfolio margining as opposed to position margining, I don't know what the size of the account you need is to qualify for portfolio margining, but what it does is it considers the correlations of the positions in your portfolio to determine what your additional margin would be at the portfolio level, not the and it's usually smaller than the sum of all the position level margins that you would need. Do you have a target for cash in your accounts? I'm wondering what your process is when deciding how much cash to hold in your portfolio such that you can write puts at any given time. I'm running a small options account and trying to find the best balance between holding securities to generate ROE versus holding cash so I can write puts on market weakness for ROE. In times like this, I tend to have a lot of cash. Not because I make any conscious decision to have a lot of cash. It's just I'm massively underinvested right now. I guess it's a very high class problem is the portfolio is quite large, which is why I offloaded some of it to an external manager, simply because I can't deploy enough of it. And even right now, I'm still massively underinvested. So I do have that nice luxury of earning a nice yield on the cash because short-term rates are so high. If they were at 0%, I certainly wouldn't have this level of cash balance because I would find something to put it in. And if rates were at 0%, market volatility would be much lower. I'd be more willing to hold very safe dividend-paying stocks at that point. But with volatility so high and a cash yield equal to what a good solid dividend would be anyways, I don't mind sitting in cash and having that tactical ability to jump in and jump out. When volatility is high, it makes sense to have a higher cash balance to do a lot more tactical decisions. If you are trying to build your portfolio over time, hopefully you have a full-time job, you have a career, and then you have your portfolio running on the side until it gets to a size such that you can then look at your job and say, I don't need you, I'm making enough over here. That you should have some kind of cash flow plan of how you continually fund your portfolio over time to build your cash. But don't get impatient. Getting impatient means that you're just going to make silly mistakes. Don't look at how much money you have. Look at how much return you've made on the amount and manage that percentage. So having a $5,000 account and making a 23% return on the equity over 1 year is very impressive, even though that only comes to about $1,000 for the course of the year. It's the 23% that you want to pay attention to. And yeah, again, early in your career, it's not going to really look impressive. Watch that ROE, and don't decide that I need more money. I'm going to make some big bets for some big payoffs, because those usually don't work out well. Are you planning to have a course uploaded on the Applied Series, specifically adding more content on portfolio management using options? Yes, this fall the options course is getting an upgrade. And one of the one of the more popular questions was around adding more about how do you use this, assuming you have a portfolio of assets already, how would you use your options to manage portfolio level risk? So more of that, I think, would be useful. So this fall, that will be added to the options course. I know you covered liquidity management and portfolio with short options. Looking for a section that covers long strategies and one that incorporates it all. Yeah, that is what I'll be putting in. Made a huge difference in my own personal account, looking at it dollar delta beta and making decisions at the portfolio level rather than on individual positions, which is what you should be doing. This is what you learn with experience, is that you want to manage the entire portfolio and the risk at the portfolio level, not the risk at the individual level. And here's why. You can add stock ABC, and you can add asset QR, and you can add another one, let's say it's PLF, whatever it is, right? If these have a correlation of 1, you really have one asset. But the idea behind a portfolio is you have ABC, which has a level of risk. QR has a level of risk, and PLF has a level of risk. However, they're less than perfectly correlated. Because they're less than perfectly correlated, you get some risk reduction at the portfolio level than you do at the individual levels. So if you're managing your risk at each individual level, you're regarding or disregarding the benefit you have from less than perfect correlations. That some of this risk and some of this risk, because of the correlation being less than 1, is already reduced at the portfolio level. So you're actually diversifying, but then not using the benefits of diversification if you manage risk at each individual level, which is why you should, in a portfolio of assets, move up to managing your risk at the portfolio level and not the individual level, because the addition of ABC was meant to manage the risk of a portfolio of only 2 assets because of the correlation that it had. I think I made my point there. Even though I get the concept of having DDB close to 0 when neutral, adding more when bullish or negative when bearish, I still find it challenging to decide how much DDB is optimal at times. Well, that is just experience over time. If there was a rule that worked for absolutely everybody all the time, it would already be programmed into almost every trading platform. Because it's not, is because it really depends on what it is you want to get done, and over time you will learn through experience what you're comfortable, the level of risk you're comfortable accepting. Forward to you covering futures course, so we can expand on this. Yeah, that is on track as well. Right now I've done the factor course, for top down. That is done. Next in top down is contraction, because I think we might see that this year, so we better be aware of what a contraction is. And what happens in a contraction and what we would want to do in a contraction. The first part of a contraction sucks. The second part of a contraction has great opportunity, and there is an inflection point between the two. And when we notice the inflection point, that's when we should not be shy. Even though the bad economic data will keep coming out, there was an inflection point that was important, and we should get on board. We'll be doing that. In the bottom up, I will be putting a mining stock in there. I haven't decided if it's going to be BHP or Rio. It'll be one of those two. But they're not American, so it's a different accounting system that they use. But I don't think that's going to be too big of a deal. Yeah, so over time, all these things will just get filled out. But right now, I'm in top down. This is done. Next is the contraction video. Could you give an explanation of what the revised figure means when data is released in the economic calendar? How is it possible to show both the reported figure and the revised figure at the same release time? How should we interpret this? The revised is previous, and the release is now. So let's look at continuing jobless claims. This was for December, up to December 24th, and this was the release on January 5th. That is the current number for continuing jobless claims. We have a revision here, for this would be for the release for the week before, for December 17th. So when we get to January 12th, this number will then be in this column, and we'll be looking for a new number, and this number, the 1694, may get revised over here to a different number. So the revision is the very last report that we saw. Is it the same number, or do we have more information now that we can make revisions to that number? I'm a U.S. investor, but wanted to get your thoughts on the new Canadian law that bans foreign investment home purchases over the next 2 years. Yeah, unless, of course, you're in the country. Yeah, so there are some exceptions to that. This really bans you if you're living in another country and you're just buying property in Canada. Would this be effective in other countries as well? I don't know. This is Canada, so Canada sets laws for itself, so I don't know if it would be effective in other countries. There's the amount of foreign investment home purchases obscurely high in Canada. It is in certain regions. Calgary, for example, Toronto, Montreal, and Vancouver. We only really have, maybe 4 or 5 large cities, and that's about it. But it does drive up the price. And many of these homes, especially in Vancouver, are purchased and they sit empty. So we'll see what effect that has. Do you have a video that breaks down the sections of figures and how you're calculating them? If you look in the description box, you'll see the source from where I get all the figures. I check your previous videos and can't find a specific one that provides a walkthrough. Yeah, just look in the description box. You'll find all the links to all the sources of which I get the data. So that first big screen that I have at the very beginning, which has all of the rates, that's from treasury.gov. Treasury.gov. When you get there, click on the menu item that says data, and you'll get another menu item that opens up, and you'll see the first one is the daily treasury par rates, and that's what I use up here. The graph is just an Excel graph that takes the line, one whole line, and draws the graph of it. For the slopes, where I write 2-year, 10-year, it's just taking the 10-year and subtracting the 2-year. That's all it's doing. They're just Excel calculations. That's it. Okay, I also went long TLT, long call, short puts. You showed me the mortgage rate increased a bit last week, but I don't know if this would be enough to explain why both agency and TLT were down last week. Well, mortgage rates have nothing to do with TLT. TLT are just treasury rates. I'm wondering, would the BOG decision still have an impact on TLT because of the carry trade? Well, you have to make a bunch of assumptions here if we think that it's going to have an effect on the carry trade. The first assumption is that there is a carry trade in this direction, that there is borrowing in Japan to invest in the US. You also have to make the assumption that the carry trade is binary like this, that there are two currencies. Typically with carry trades is you'll have a basket of low yielding currencies that you borrow in, and you invest in a basket of high yielding currencies, so that you have diversification of funding source and you have diversification of return source, as opposed to huge risk like this, because you have huge currency risk sitting there right there, and you have huge interest rate risk sitting over here, because if you're borrowing here and investing in the US and interest rates go up, you may think, well, that's really good, but your bond price goes down. And if your if interest rates go up enough and your bond prices go down, you're going to have to close this trade because you got to pay back that amount. So usually it's baskets. So it's a matter of, well, how much was going on in terms of money being borrowed in yen, invested in US, and how diversified were all those things. And if they were primarily diversified and this was a low directional trade, then it would have minimal effect. However, I will say this, it will have an effect on the treasury to the extent that market participants expect it to have an effect on the treasury. Market expectations play a huge role in the direction of asset prices, because if I expect something to go up, I'm going to buy it, which pushes up the price, thereby validating my belief and everyone else's belief that they expected it to go up. Which is why managing expectations is crucially important. So the Bank of Japan did say, this is not the beginning of anything, everybody. We're doing this one little thing to make the market a little bit more efficient, but this is not the start of anything. They said that. So hopefully that manages the expectation of the point where market participants go, oh, okay, it's not the start of anything, so I won't start anything either. Or they may say, you're just telling me it's not the start of anything because it is the start of something and you don't want us to move the price on you. Yeah, it's a big game of poker, right? Finally, there was one other comment. This is what all this is related to, about triple levereds. And I said that they typically walk themselves down to zero, and this can be proven mathematically. So let me just show you the difference between the two. Here's the index, and here's a triple levered ETF. And we'll start them both at 100. And on day one, the index falls 5% to 95. Well, if it's triple levered, this will fall 15% to 85. The next day, the market goes from 95 back to 100, so that there is over 2 days 0%. That's a 5.26% increase. Well, you're not compounding that here. You're multiplying it by 3. It's triple. So it's 1 plus 3 times 0.05. You multiply the 85 by that, you get 98.14, which means the triple levered ETF has lost 1.6% on a flat market over 2 days. And because it's tripled, they eventually, if you have a market that does this, right, these eventually walk themselves down to zero. So in the past, it was quite common. I don't follow these anymore, so I don't really know, but I know around before the financial crisis and after the financial crisis, it was very common. Whenever you have these 3 times levered, there'd usually be a 3 times long and a 3 times short, because these are easy to manage as a portfolio of the two, as opposed to 2 individual ones, as opposed to just saying here's a triple long. That they would both walk themselves down to zero over time. It was quite common to do reverse splits. So if they start at 50 and 50, you might find that after about 4 years, they're $10 and $11. And you think, how can they both possibly be down if they're inverses? That's what they do over time. That it was quite common to have reverse splits, like let's say a 5-for-1 split to get this back to 50 and this would be to 55, and then they would start their walk back down to zero again. That one of the common trades at the time was that if you had a long and a short, you would short both of them as a portfolio, because the combination of the two would walk themselves to zero. Maybe the sponsors have fixed that over time with adjustments inside the ETF to account for the fact that there is going to be that massive tracking error. But they do tell you these are daily returns only. So they're giving you fair warning. And if they're daily returns only, then mathematically they will walk themselves down to zero. You can prove it mathematically. The only time that these are worth holding for more than a day is if you expect a market to trend in one direction for an extended period of time. Then that becomes really powerful. The triple levereds become really powerful if you expect that to happen, but it has to happen. Other than that, use them for single-day risk management, either to accept risk or to get rid of risk. But if you're going to do that, and if you're so excited about triple leverage, try futures. ES is 50 times the S&P, 50 times. Or if you really want to get excited, use the SPX. That is 250 times the index. You can get leverage out of futures contracts. You don't have to go into these triple levered ETFs, because they're using a combination of futures options in the underlying to create that on a daily basis. You can get it yourself. So all they're doing is packaging something that you could have figured out how to do on your own. But mathematically, this is what you get. So if you are looking at one of these, you would have to look at them and say, how do you solve this problem, this drift problem towards zero over time? Because it will happen, especially in markets that are non-trending. In non-trending markets, this is quite common.